Hey everybody, welcome to the Thursday evening live stream. Of course, as we do every Thursday, or most Thursdays, not every Thursday, but most Thursdays. I hope you're having a good week and that the weather is treating you kindly wherever you live. What are we going to talk about this week? Well, got quite a lot of stuff to get to. We're going to look at what's going on with the peer-to-peer lending news. Obviously, Collateral court case started this week, which is sort of big news in the peer-to-peer lending world. So have a little chat about Collateral. We are going to talk about, at the end, I came up with this thought about what would I tell my 20-year-old self now that I am the big 50, middle-aged man. So what would I tell myself, 20-year-old self? So I'm going to tell you three things that, I would definitely tell myself knowing what I know now back then. Take a look at the Trading 212 portfolio and some ideas and things that I have about that and how to position money defensively in a time of economic challenges, which I think we're in right now. We're in the deep depth, murky waters of economically challenged times. And there was a report that came out by the IMF, the International Monetary Fund. I also call them the International Monster Fund because it's kind of what they are. But they put out a report today which sort of highlights some of the things that I've been saying recently about the economy and how I'm a little concerned about investing. Not just a little bit concerned, a lot of concern. So we're going to talk about that and a couple of things that I found that are interesting out there in the financial news. So we're going to, without further ado, get to it. But just to remind you, I know this week we were supposed to have a live stream guest, and last week, but unfortunately I was canceled on again. So things have been rescheduled a little bit. We're working on it, but here's the upcoming schedule. I'm pretty sure this is exactly the way it's going to be. Next week, April 27th, we have Folk to Folk here. Roy and Gary, they are confirmed. So this is rescheduled from, I want to say, last month, March. So that is definitely on the books for next Thursday, so tune in live. We're going to talk to Folk, which is technically the biggest retail peer-to-peer lender right now in the UK. So pretty interesting. Oh, let me just turn on my Do Not Disturb here. And after that, May 4th, we have Susie from Peer-to-Peer Finance News. She's the founder of Peer-to-Peer Finance News. We're going to talk just general peer-to-peer lending and investing. Really looking forward to that chat. May 18th, we have Steve here from Capital Stackers. Again, that's another reschedule, which is about as sure as it can be on the books. May 25th, Peter Reed from Assets Exchange and Cufflink, who is supposed to be here today, this evening has had to reschedule. But we will get them probably slotted in maybe on the 11th of May, depending on their schedule. But I did have a interesting chat, and I'm actually making a new video with the chief operating officer of Cufflink. We had a really good, it was probably about half an hour. We did an interview about how a deal from the borrower side looks from start to finish. So you as a investor who, you buy into loans, you can really see what the start A point is down to the finish point. And I've always wondered about that. What exactly are the steps that they use? So we kind of went through about 13, 14 different steps that Cufflinks uses to analyze a deal and how they get it up onto the platform for you to invest in. So I'll be editing that video likely today and tomorrow, hopefully to have it up tomorrow. It's a brand new video coming out, but check them out. They'll be back live hopefully on May 11th. So yes, apologies for that, but I know, sorry about it. nothing I could really do. They said they weren't ready to do it, so we're getting a new guest from Cufflink, I believe is the head of risk, and he just wasn't prepared enough to do it, so he asked for a reschedule. It is what it is. Also, this stream is generously sponsored by actually Cufflink, big friend of the show. They have generously also sponsored the Harley Cam, which is pretty cool. She just likes being famous. So yes, please check out Cufflink if you do not have an account with them. They advertise earning up to 9.73% gross per annum, over £250 million of property-backed UK investments made since 2016, and 0 investor losses to date. Very important. Don't forget that your capital is at risk and you should never invest more than you're prepared to lose. So sign up at join.cufflink.com/financial-thing. I'll be going to visit them actually in June to the offices of Gravend, so I'm sure I'll probably shoot a video over there too. But yeah, big thanks to Cufflink for sponsoring the stream. Oh, we got to put that little logo up. Oh, there we go. And then where is the... Hang on one second. We'll put the little Harley Cam up there for anybody that's just like watching her. I think she's far more interesting to watch than I am. But yeah, thank you to Cufflink for sponsoring the stream. Let's get right into the news and the content. Please hit that thumbs up if you can. Hopefully you enjoy the content enough to want to subscribe to the channel or join the Patreon. I do this for love and not for money, but we do have costs to pay. So let's get into it. First thing on the books, Capital Rise live loan book is now up 125%. So they are going from strength to strength, apparently. This is Uma Raja, who, again, if you haven't seen the interview I did with her live, it is archived on the Financial Thing YouTube channel, so go check that out. But Capital Rise has seen its loan book grow by 125% to 138 million year on year from the end of March 2022 to the same point in 2023. Capital Rise focuses mainly on London-based developments, so lending to London-based developments, which I got to admit, when I first started looking at Capital Rise, I was thinking, oh, London, that's a tough place to be lending money because you're talking about big deals and large amounts of capital, but they seem to have figured out how to do it right, so which is not an easy thing to do. The firm has reported a strong first quarter of the year, which they attributed to a combination of heavy investment in its origination team and a favorable marketplace in which banks are not quick to lend. Raja said the Capital Rise has done 200 million of lending total, in which 117 million was just in the last 12 months. In the financial year ending the 31st of July 2022, Capital Rise recorded an 89% year-on-year growth in loans originated and paid out more than £46 million to investors in capital and returns. The lender's gross profit margin for the period was more than 70%, with revenue tripling over the past 3 years. So, strong financials that Capital Rise is putting forth, at least in this report. So, go check them out. What stricter rules means for peer-to-peer lending cashback deals. Now, as you know, the FCA is putting new regulations into place that will present lenders like you and me receiving cashback incentives from peer-to-peer lending companies. So before they used to say, hey, if you want to sign up for a new account, we'll give you £50 or £100 free. Or if you invest X amount, we'll give you X amount. Now the FCA is saying, nope, not allowed to do that anymore. But there are a couple of different incentives that you can get that was highlighted in this article. They're not as good as specifically cashback deals as what we've been used to in the past, which has always bumped up the amount of returns that we've made during the year because of that extra incentive. But they are something. So Assets Exchange offers a premium investor community for all investors who invest £50,000 or more with the platform. One of the benefits of this community is access to cashback deals, which are made available under the completion of a new property purchase. Now, admittedly, I'm not exactly sure what that cashback deals look like and how they manage to get around the FCA regulations, but you do have to put quite a lot of money in, 50 grand or more with the platform to see access to that. Crowd to Fund offers existing investors a refer to earn scheme, so basically a referral, and then you get cash back after 12 months. Easy Money doesn't have any cash back to investors, but it offers something similar. All users who invest £1,000 in the platform for 6 months get free access to Easy Money Plus, which is a loyalty scheme which offers savings up to £1,000 a year with exclusive benefits and cash back. It's a card that can be used to secure discounts of more than 1,000 UK-based realtors. So again, it's something. It's not a huge deal, but it's something. So you're getting something for nothing. And then Dublin-based Lender Marketplace works with a number of loan originators which allow occasionally cashback deals. In February 2023, Lender Market was advertising 2% cashback on all new investments in Credit Star's long-term loans. So there's a little bit of incentive out there. It's again not like we've been used to having in the past, which was really nice when we signed up for new accounts. We would just get a little extra incentive, but that really doesn't exist anymore. So something is better than nothing. Okay, so Propland has repaid its 6 initial VAT loans that have been repaid in full. That's really good news. They've lent a total of more than £4 million since the project was launched in 2021. What a VAT loan is, and for anybody that's not in the UK, it's value added tax, which is basically the US equivalent of a sales tax, and it's 20%, so it's high. What happens when a borrower wants to buy a property? Well, on top of that, they have to pay VAT to the HMRC, and sometimes these borrowers don't have enough to cover that. So what they do is they can borrow that money from Propland to pay the HMRC and then take that as a loan. It's a short-term loan, usually of between 90 to 120 days. The VAT loans pay a 9% interest rate. It's an interesting concept because this is definitely a problem for a property developer. If they imagine they're borrowing £1 million and they have a 6-figure VAT to pay to the HMRC, well, they got to get that money from somewhere. Not only do they need money to put into their development, which a lot of developers do put their own cash into building projects, but they need that VAT money, so they can go to a place like Propland, borrow that money in advance, pay the HMRC, and then just repay it over a period of 90 to 120 days. So it's a unique project. It's a unique product, and Propland is showing that it does actually work for them, and they have gotten the repayments on those. And it's something you can invest through. If you have a Propland account, you can actually invest in those VAT loans. So good stuff. Propland's instantly accessible Tranche A loans have an average lender rate of 6.3%. Yeah, you definitely also want to make sure that you are getting paid back enough to make the risk worthwhile. You really need to do your due diligence on that, because VAT loans do also have risk. Of course, if you're getting 9%, there's some risk involved there, so just be aware of what it is you're getting into. Crowd Property has secured a £15 million funding line from the British Business Bank. That is from British Business Investments, the commercial arm of the British Business Bank, and it will be used to support more house building in the UK. The British Business Investments is a subsidiary of the British Investment Bank, which is a government-owned development bank. Since 2014, British Business Investments has lent more than £3.3 billion to smaller UK businesses. And then also on top of that, Crowd Property did actually reach its fundraising campaign on Cedars. Now they've raised £481,000, which is a good thing. So this £15 million credit line just means there's going to be more, building loans that are given out from Crowd Property to building contractors and developers. So more deals on the platform, hopefully. UK peer-to-peer lending revenue is going to reach £376 million this year. I was thinking about that headline, and £376 million is in the grand scheme of things really not huge in the financial sector, but it is something, and it is growing. That's the most important thing. We've seen some really big hiccups in peer-to-peer lending over the last few years, and it's nice to see a report showing that the revenue is going up in the right direction, because we definitely don't want to see it going back. And if you think about it, peer-to-peer, the market size in 2013 was just 20.2 million. So that's quite a big jump. 2016 saw the biggest growth in the peer-to-peer lending sector, revenue climbing by 86.6% to reach just under £100 million. Last year, the total revenue of UK peer-to-peer lending platforms hit 335.8 million, and Easy Money has predicted that by the end of 2023, this is going to go up to 376 million, which is about 12% growth. What does that mean to you? It means that hopefully peer-to-peer lending, the sector in general, is healthy. Number one, is what we need to see. Revenues are climbing. That means the companies are making profit and doing well, which means more loans to you and more opportunities to invest. So I would say, yeah, that's definitely a good thing. Let's see, what else? Invest and Fund. They put out an interesting blog recently, and this kind of goes back with the last news story from Easy Money saying that the peer-to-peer lending sector is growing in revenue. And Invest and Fund has said that they're expecting a gradual rebirth of peer-to-peer lending as an investment aggregator for housing development. And they say, first, we see peer-to-peer lending evolving into a structured product for investors to get exposure to property development in the same way that significant Wall Street funds will expose them to ownership. We believe that the rise of products mentioned above, they're talking about peer-to-peer lending products, we believe that the rise of the products mentioned above will embed the peer-to-peer model in the public consciousness as the expected way to invest in housing development. And that will bring in significant wealth and significant players into the sector, people who traditionally would have been involved in other types of debt forms, seeing the opportunity that the nation's massive building requirements hold. I'm talking obviously about the lack of housing in the UK. Peer-to-peer lending platforms will be the custodians of that opportunity, in the way that funds will be the custodians of real estate investments by being placed and experienced to pick up the torch. And if you think about it, right, if it weren't for peer-to-peer lending, it would be very, very difficult to invest in real estate developments, period. I mean, that's something usually offered privately through things like private wealth management or family offices, where they say, hey, would people like Hanf do that? They could pool money together, and they're a family office and they invest in real estate. Usually, if you're not involved in the family office, you don't really have a chance to invest in real estate development. So peer-to-peer lending is a very easy way, albeit, of course, there are risks. You got to go to the right platforms to do it. But it is a way you can actually get your feet wet into real estate development without having to put up tens or hundreds of thousands of pounds or dollars to do so. So I think as we start to come out of this fog of these collapsed lenders of the past who've really done a really poor job of running their businesses, and the businesses that are doing well, like, the crowd properties, Cufflink, Propland, Blend, continue to show strength, LoanPad, places like that. I think peer-to-peer will experience that rebirth where people come back to the sector, get more confidence in it, and continue to help the sector grow. Okay, let's talk about Collateral. So Collateral this week entered into their court proceedings where the Curry brothers, who have been accused of fraudulent activity, are being brought to justice finally in front of the judge. Now, the court actually reached out to me several months ago and asked if I would be a witness, so to speak, to provide evidence towards that case, which I totally agreed to do, number one, because I was an investor through Collateral and just got burned the same way hundreds, if not thousands of other people did. And I know they started their court proceedings on Monday. This trial is supposed to last for 5 weeks. But I also got an email a couple of days ago saying, oh, the court actually doesn't need you, but could you be prepared to be available for the next 5 weeks? It's a little bit difficult to make yourself available for 5 weeks, but I said, yeah, I'll provide any information I can. I obviously, being over here in the US, have to do things by a video call, which they were totally okay with. But the most important thing that I can tell you is that it's good that these people have been brought to justice, because there are so many cases of financial mishandlings and fraud where people get away very lightly, if not completely scot-free, and never brought to justice. It is very difficult to bring people to justice anyways, because number one, they got to catch them, and number two, they have to have the right type of evidence to really prove that there has been wrongdoing. And people, nowadays have different ways to shield money. We see that happened in the Lendy case, I believe. Again, I'm not pointing fingers or blame, but it's just my belief that there's a lot of things that have gone wrong within that company, but moving money around, shielding it, moving it offshore, having blanket companies and things like that. So I'm really happy that Collateral has, the Curry brothers are going to face their day in court. Now, if they did do something wrong, I'm all for throwing the book at them. If it turns out that they didn't, hey, that is what it is. We have to go by the letter of the law. But I was doing a little search on the Wayback Machine, which I like to do. This is what the Collateral website actually looked like. This was, I think, back in 2015, before they were even advertising peer-to-peer lending. And what they were advertising was a more of a pawn, P-A-W-N, not P-O-R-N, but a pawn-style business. So that they were lending money against jewelry, watches, gold and silver, vehicles, and property. Now then comes Collateral's new website. This was in 2016, I believe, where they started opening up to peer-to-peer lending investors, where you could put money in and have this juicy 12% interest rates. And me, being young, dumb, and naive, saw that 12% interest rate with stars and greed in my eyes and said, wow, this is really a great thing, right? I can put in £1,000 and make £200, £350 of interest a year. This is great. 1% a month. How can that be a bad deal? And just believing that this was real. Now, if you look at this website, you can see at the bottom here, and this is the main reason that Collateral got in trouble. I don't know if you can see this, but it says at the bottom, Collateral UK. Let's see if I can zoom in a little bit more for you. It says at the bottom, Collateral UK Limited is authorized and regulated by the Financial Conduct Authority, the FCA. And this is a reason they got themselves into trouble, first of all, was because they were actually operating not under the Financial Conduct Authority. So that was a big lie. They were saying we are regulated when they were absolutely not regulated. They were taking money in. So, and then, of course, the fraud allegations came up. The money had been moved around, people's money, the investors' money, and eventually the FCA was able to build a case against them and proceed forward with criminal charges. So this was published in January of 2022, saying that the FCA has commenced criminal proceedings against the two former directors of Collateral, Peter and Andy Curry, who faced 2 charges under the Fraud Act of 2006 and 1 charge under the Proceeds of Crime Act. The FCA alleges that the Currys, who are brothers, dishonestly represented to investors that Collateral was authorized and regulated by the FCA. And shortly after Collateral was asked by the FCA to cease conduct of all regulated activities in January 2018, and shortly before the company ceased trading, the brothers dishonestly abused their positions by transferring funds to a separate company and, in addition, transferred further sums that they knew or suspected were the proceeds of crime into their own personal bank accounts, namely the bank account of Andrew Curry. Collateral is now insolvent and in liquidation. They were due to appear at Westminster's Magistration Court on the 26th of January 2022, and now, starting this week, which I think was on the 17th of April, have had their day in front of the judge. Again, this is going to last for about 5 weeks, they say, and they are accused. This news story is pretty good. It's Law 360. Just go through this real quick. Two brothers at the helm of a peer-to-peer lending company tricked investors into parting with £15 million, which is $18.6 million, by telling them the investment scheme was authorized by the British FCA watchdog when it wasn't. Andrew and Peter Curry lied in their pitch to investors to attract financial backing for their company between 2015 and 2018. They misrepresented the fact Collateral wasn't authorized or regulated to reassure the public that the company was legit and safe amid a peer-to-peer lending boom in the UK. Now, of course, these two brothers have pled not guilty, because that's pretty normal. Collateral says look like a peer-to-peer lender. There are only a few borrowers, and they tended to be pawnbroking and construction businesses. So this is the thing that makes me really upset here, really upset at the bottom. The FCA has alleged that the brothers took more than £600,000 out of the business prior to its collapse for their own benefit. So if they did in fact do that, and the records I'm sure are pretty clear, because that kind of stuff is easy to trace. That is one good thing about the banking system, that everything is traceable. You take out money, you can trace it to where it goes if it's electronic. If they did in fact do that, then very, very wrong. I mean, yes, I hope that they get the book thrown at them for doing that. This is not the first time within peer-to-peer lending that we've seen allegations of fraud. Of course, we have the Landy situation in the Marshall Islands, where they had supposedly hired some companies out there in the tune of £6.5 million going offshore to these entities to do work for Landy, which turned out to be a big fraud case. But there are also, plenty of examples of fraud, not only in peer-to-peer lending. For example, this story: finance managers jailed for defrauding Libyan wealth fund out of $10 million. Now, and this was published on the 20th of February, two fund managers have been jailed for a total of 11 years after committing a large-scale fraud amounting to more than $10 million US, which resulted in the loss of money meant for the people of Libya. What I like about this story is that they've been punished appropriately for what they're doing. It talks about the defendants sobbing in court and, being really, really sorry for what they did, and they paid back $2.8 million to victims, blah, blah, blah. But one of the guys here, let's see what his sentence was. And this is the thing I was concerned about with these cases of financial fraud, that sometimes they get suspended sentences, which basically, I think of this story, it said they had an 18-month jail sentence. One of them, it was suspended for 2 years. Basically means he doesn't go to jail at all. It just means that if he behaves himself for that suspended sentence, he would not have to face any prison time. But these guys, they knew what they were doing, and unfortunately, I think in fraud cases like this, that people like that will generally go out and do the same thing again because they know they can get away with it. They've been disqualified from acting as a director of any company for 12 years and 5 years, the two people. And I believe they were sentenced to, let's see if I can find it. Here you go. Marino was jailed and sentenced for 7 years and 6 months, and Omura was in prison for 3 years and 6 months. Neither of them have attended the hearing, and warrants for their arrests have been executed. So I don't know what type of punishment that the Curry brothers are going to be facing for their involvement if they are convicted of fraud in this case, but I'm hoping it's not going to be some kind of probationary or suspended sentence, because a lot of people lost a lot of money due to their negligence and fraud. So even if you try to go to the Collateral website too, by the way, now this is what you're going to see, a website that is completely taken down and removed. So let's pray that the legal system does the right thing, finds the real truth about what happened with the collateral and where that money went. Do I expect to get any money back? No, absolutely not. Part of a learning experience. Actually, one of the 3 things that I told my younger self is going to be to do with that. But let's see what happens to them in court. Talk about the economy. 1 in 4 Brits financially vulnerable amid cost of living crisis. Nearly a quarter of British people are financially vulnerable, of which 20% have already missed a monthly mortgage or rent payment. This is really, really sad. 23% of respondents this is an open banking firm, Tink, found that they have no longer got an income that supports essential spending. Of these, 56% said the situation will worsen as they expect their discretionary income to fall over the next 12 months. When you get reports like that, coming out, again, this kind of goes back to the things I've been saying about the economy being in a pretty dire state, even though it doesn't necessarily appear like that. On the surface, it seems like everything is just going along as normal, but we saw these news stories coming out and this bubbling under the surface. It's like this volcano, this volcanic activity that's going on under the surface of the volcano. And then all of a sudden one day, just boom, and then everybody's scratching their head going, oh, I didn't see that one coming. You got to pay attention to these types of news stories. And particularly this right here, the IMF has put out a World Economic Outlook projection. Now, the IMF put out, it was like 150 pages. If you want to read the full report, you can. Some good snoozing material. But this is why we have a problem. You can see here in the UK, this is World Economic Output, so real gross domestic product, annual percent change. So this is the amount of income that's being brought in by a country as a whole. It was 4% in 2022 in the UK, dropping to minus 0.3%. So that's a 4.3% negative backwards for 2023, and then projected to increase by 1% in 2024. I think that's a very optimistic number. If you look in the US again, I think it's the barometer for the world in many cases, 2.1% in 2022, and falling to 1.6% this year, and down to 1.1% in 2024. I, in fact, think this number in the UK will probably be at 0 in 2024, but that just shows how there is really no growth going on in 2 of the main economically powerful countries of the world, the UK and the US, which is why I get particularly nervous about the investment side of things right now and knowing really what to do. Where the hell do you put money when things are just so turbulent? Now, just take a quick look at the Trading 212 portfolio, which I've taken a really defensive position on this. It's actually doing okay. 14,731 right now. We have 6,700 in cash sitting there. This is what I'm really trying to figure out what to do. And I've actually been looking at possibly the option of not putting it into stocks at all, because if you look at some of the stocks and what's going on today, nothing is really looking very good. The monster Tesla stock is down 10.7% today. Everybody's so high on Tesla stock. That's not looking good. I thought too, maybe a dividend, maybe building like a dividend pie to create dividends. But if you're averaging a 3% dividend and your stock happens to go negative by 10% or 15%, whatever we're watching coming down the pipe, does that dividend really make a much sense. No, it doesn't, because at the end of the day, we do have to watch out for the stock price. Now, again, if you're a very long-term investor, you probably just want to stay the course. This Trading 212 account was really built for more trading, which has gone well, but we've had a big pullback. So I was thinking about taking a portion of the cash and putting it into a very defensive position. We've seen almost, and if you look at the Vanguard S&P 500 index ETF, you've seen actually close to, if we go back to where we are now, 62, right here, that was October 17th of 2021. So basically you've seen 18 months of absolutely zero growth. And when I spoke about there possibly being a decade long of absolutely flat stock market returns, so zero returns for a decade, people were saying, that's silly. There's no way the stock market can do that. But we're already 18 months into seeing an absolutely flat return. And just as we get some hope, we get a pullback, hope, pullback, hope, pullback. And it seems to be the same. So what is there to do? Well, in the US, I know this doesn't apply to the UK, but it gives you something to think about, maybe trying to find something similar as a defensive position. There's a fund in the US called the VUSXX, which is a Vanguard index fund, and it's a treasury money market account. And look at the yield that this fund is paying right now. So this is an annual compound amount based on the 7-day yield that is paying out right now, which is 4.63% annually. This changes every week. It's at a pretty high level right now, but look at the risk. You're at a 1. So very little risk and a very low expense ratio. In the US, you do need to put in a minimum of 3K, so that is one of the downsides. But there could be some kind of alternative in the UK that's considered a more safe defensive position. Let's see what we have in the UK. This is through Vanguard's account here. So I guess maybe the equivalent would be a US bond index fund. I'm really not a big fan of these bond index trackers though, because as you can see, if you look at the risk level of a tracker like this, you're at 3 out of 7, which means there is fluctuations in the price of the bond. You can see there's a US dollar treasury bond, again, 3 of 7 risk. Is there anything in the UK? You've got UK bond. Look at this UK bond index fund. Risk level 5 out of 7. I mean, this is kind of a crazy level of risk to be taken for. Let's see, I don't want to purchase anything, but I don't know. I think maybe trying to find something that is considered lower risk. You can get I think I just saw another interest rate rise from Ford Money up to 3.6%. What I was trying to do is identify something that paid a little bit more than that. There's more of like a money market savings fund, but not something where you had to put a bond in for a year where you get stuck. Because if those interest rates do come back down or even go back up even higher, then you're kind of stuck in this bond. And I'm really not a fan of those long-term bonds, especially if you're only getting, a 1/3% more to be stuck in a bond versus like easy access. So I was trying to see if Vanguard in the UK had something equivalent to what I found in the US. Right now, even these gilts, they're looking, risk levels are high, and that's a bond fund. So let's just take a look at this UK bond index fund, which I would have considered to be much lower in risk, but apparently it's not. And the problem is these NAV prices here. So this is the price of the bond fund. These things change. So as interest rates start to rise, these bond fund prices start to go down, and that's why there's risk right now. That's why there's risk is high. If we look at the price and performance, you can see here, this is your risk factor right here. Look at this bond fund. It's gone down from 142 pounds at its height all the way down here to 130. This is a bond fund. I mean, you don't want to be investing into something to do with bonds, and this is a government fund that is going to cause you to have a loss as interest rates start to go up. Let's see if the US one is any better, and plus it still only pays like a 2.15% yield on this US government bond fund. This is the UK one you can buy in the Vanguard UK, but I just haven't found anything that is very similar to this money market with that low risk. I don't know if this fund is actually available in the UK. I'm thinking it's probably not, but there may be a way for you to buy something like this through one of the brokerage accounts in the maybe in the US that services the UK, or the other way around. I'll have to look more into that, but this is a pretty attractive yield, and you can access this if you put a market order in to sell this fund. You can pretty much be out in the next day. So it is kind of like an easy access fund. And look at the dividend yield. It has gone up a lot. It's gone all the way up as interest rates have started to rise up. So 0.91% back in July of 2022. And all the way up to 4.61%. So you do have to keep an eye on the dividends on what these funds pay. But I think it's a pretty good choice for a defensive position if you are able to find something similar in the UK, or you can even buy this fund in a UK brokerage account. Yeah, so that's what I found. I think defense, protection of capital is really, really important right now. If something does come down the road towards us with some kind of a stock market correction, you position yourself, even if it's just part of your money, defensively, and then that correction does happen, you could take that money and reinvest it into equities whenever you feel comfortable doing it. Or you could just say, screw it, I'm going to stay invested long term, not try to time the market, which I think is best for 95% of people out there. But I do like that treasury fund as a little bit of a defensive play instead of being 100% stocks and equities, which you can see this portfolio absolutely is. And it's not doing great. The only saving grace, maybe is a saving grace, is the Deutsche Bank shares have rebounded a little bit, and I thought they would. I think this banking share price that Deutsche has hit will probably end up rebounding. That's why I wasn't so quick to sell it. You can see down here from its low point at what was that, down 8.24 euros, and we're now back to 9.9, so that's kind of why I stuck with that one. The other ones just haven't fared so good. Collateral is still getting the poo beat out of it, as is a lot of the other stocks. So again, that's why I decided to take that defensive position going into cash, just to try to retool things a little bit and sort of have a bit of a better game plan for the economic uncertainties that are coming. Okay, and finally, I wanted to show you 3 things that I would tell my 20-year-old self. I was thinking about this, pondering this the other night, thinking, well, I've turned 50. What would I tell myself 30 years ago? 3 things, 3 important things. So I decided to write them down and share them with you. Number 1, this is the most important thing. I would start telling myself to start investing early. It was not something that I did when I was 20 years old. I wish I had. The only investments I had when I was 20 is my dad bought, £100 worth of BT shares, or when those public companies started going private, he would buy the 25p share certificates for me. But I had no idea how to invest. I really had no interest in investing at all. But yeah, start investing early. And of course, the most important thing about that is compound interest, right? This is a crazy thing. Compound interest is such a beautiful thing. And I was putting in some numbers here just to see if I'd have started when I was 20. And I put £100 in to start at an interest rate of 7%. So if I'd invested in an index tracker 30 years ago, I could probably expect to easily get 7%, if not more. And I put it in for 40 years. I said, I'm going to do this until I'm 60 years old. You'd be just kind of surprised at the numbers here. Let's say I put in £100 a month. And I know people who are 20 don't always have an extra £100, but you could find it if you really want to. And I said, well, what if my annual deposit increased 5% a year? So first year I do £100, next year I do £105, and so on and so forth over 40 years. What would that actually look like? Look at these numbers. £517,129 by the time a 20-year-old hits 60 based on 7%. That is just a mind-blowing number to me. And you know what's even scarier, though, is this is what I started doing. I started when I was 40 years old. So instead of 40 years investing, I did 20. And let's just look at those same numbers. Look at that. £77,433. This is why it's so important, young people out there, if any of you are younger and you're watching this and you're wondering, how do I get started? Start buying index trackers when you're as young as possible, and you're going to invest more than £100. This is the crazy thing. As you get older and your income hopefully starts to grow, you can start putting in more money. But if you start when you're 20, start with £100 a month, increasing a 5% deposit increase a year, you're going to be over £500,000, and that's a beautiful place to be. I mean, I think you can pretty much guarantee with your income earning potential that you would be a millionaire if you started when you were 20. That's the first thing I would absolutely have told myself when I was 20 years old. What is the next thing? Number 2, having said that, life is more than just money. I'll never forget the year that my dad retired when he was 66 and he got his cancer diagnosis. So my dad actually, he led a pretty balanced life. He didn't, I wouldn't say he was a workaholic. He definitely worked a lot, but he had a work life and leisure and home balance where it wasn't always about work and it wasn't 100 hours a week. There were some times where he worked a lot, but other times where he didn't. And that's what I came to realize, that life is definitely more about money, because nothing is guaranteed, right? We don't have a guarantee about how long we're going to be on this earth for. My dad, when he got that cancer diagnosis, he worked his whole life to get to retirement and gets diagnosed with cancer. I think it was the same month he retired. And he was a good example of somebody that didn't make his life about money. And it was a good lesson for me to learn that just enjoy life. Like, don't chase money all the time. And when I was 20 years old, I was all about the money. So focused on, I got to make money. Work, make money. Life is definitely more than just about making money. And number 3, do investment due diligence. And this goes back to the thing, these stories about these companies that are committing fraud. And not only that, I've made some really big investment mistakes during my life on this earth, and nearly all of them was because I just didn't do enough due diligence on what I was investing in. If you go back to the peer-to-peer lending stuff, investing in Collateral, for instance, not doing due diligence on the people running the company or what the just even checking to see if they were FCA authorized, going into the FCA database and looking. I didn't do that because I was completely green, had no idea, and I placed too much trust into the things that these companies advertised, and that they are actually going to pay me 12%. That was just stupidity on my part. I have no one else to blame other than myself. Going back prior to peer-to-peer lending, I've made several investment mistakes. I've lent money to people that own businesses without doing the correct due diligence on those people to see if they were really worthy of them borrowing that money, and got burned pretty badly when I was in my 20s to a 6-figure sum, lending money to a business who was running a bar. Bad idea, didn't do the due diligence, took too much for granted, and it was very complacent and kind of arrogant and kind of greedy too. So you've got to do your investment due diligence. Just because something advertises to be so, you just can't take that at face value at all, because that is completely the way you get burned. And then also, there are other people out there that just actually lie about who they are and what they're doing. I got burned by just recently, within a couple of years, somebody who was collecting money for charity that was a friend of a friend, and I believed them. I didn't do any research into the person. I just believed what they were doing. I gave them money for investment into a charity, and it turned out to be a complete fraud, and that money was gone. And it was just a lesson learned about doing investment due diligence. Even if you're giving charity money, just do some due diligence on the charity and make sure they're really who they say they are. So that's 3 things I tell my 20-year-old self. Not the most profound things in the world, but I think number 1, number 2, and number 3 are really, really important, and things that I really didn't know back then. I was very green and naive. Nobody ever sat down, told me these things. So that's what I would tell myself. And then finally, this quote came up on my Twitter recently, which I found really, really inspirational. So I thought I'd share it with you guys. It was very random. For the 4th straight year, I've run at least 10 hills every Wednesday and Sunday. 10 below and 100 plus, so that's degrees. So through freezing and heat. Rain, sleet, and snow, pre-dawn and near midnight. I never miss. It sucks. Each rep, I want to quit. Instead, these thoughts callous my mind and fuel my every step. There's a picture of this guy running these hills. That looks absolutely miserable. But I just love the fact that he's posting about something that he knows is good for him. So he does it, even though it sucks. And every time he runs a rep up one of these hills every day, he just wants to stop. And I love this line, these thoughts callous my mind and fuel my every step. So, yeah, I've had many times in my life where I've just wanted to quit. And I realized that whenever something is tough, that's what I'm supposed to do. I'm supposed to take on the challenge. Like building this financial thing website, and the community was tough, right? But every time I thought about quitting, I just thought, I have to do this. If there's something that's difficult, I have to take on that challenge and really keep on pushing through, because that's what life is about for me personally. It's just taking on challenges and persevering through them and not quitting. So I really love that quote, and I thought you guys might like it too. So that's what I got for you today, this evening. Holly is absolutely content and happy sleeping away. Don't forget to visit Cufflink too. Please, our sponsor. That's how you can support Financial Thing. And come back next week to the Folk to Folk stream. That's next Thursday, 7:30 p.m. Don't be late. Okay. Let's see who's here. Colin Perry, Mike Powell, Alan Toombs. I forgot to do the hellos today. Sorry, I apologize. Yeah, talk about the oh, I know I'm not supposed to talk about the collateral case, but I'm just reporting things that are out there in the news, Mike. I don't think I'm going to get slapped on the wrist for that. Oh, I like this comment. Generic Penguin. They haven't been brought to justice yet. British justice, the best money can buy. I have no doubt in my mind that they will be brought to justice. I do. You can always sit on cash, Lawrence, till another black swan effect. Yeah, you can, but it kind of goes against my investing protocol, which is not to sit on the sidelines for too long, because it's such a difficult one. If I believe what's going to happen is coming, but it could take 2-3 years, and then you sit on the sidelines and you can miss out on things happening, good and bad. I stick spare cash in loan pad. That's not a bad idea. Oh yeah, I did see that there is a Vanguard Sterling. Why did that not pop up? I saw that account. Let me see if I can search for it. Where is it? Here it is. I don't know why that didn't pop up on the stream. Here you go. This was the equivalent I saw. You're right. I knew there was something that was there. The Sterling Short-Term Money Market Fund, which I guess is sort of the equivalent of the US one. It doesn't pay as much as the US one, but it's got a pretty low fee, 0.12%. I think it pays distributions 2.27%. So not bad, but I mean, if you're getting 2.27 on a distribution, I think you're better off in a instant access account. But it's not terrible, but it's definitely not equivalent to what the US one is paying, which is 4.63. I like self-storage companies. Yeah, self-storage is good. Yeah, that's pretty good. I'm not a crypto fan. I tell my 20-year-old self to mine Bitcoin and sell it at 60K. Yeah, right? Interesting idea to do due diligence, but I don't know how to do that. You can just take the directors of the company's names and just Google them. See if they've been involved in any other businesses in the past. Go to Companies House, see if they've been directors of other companies, see if they have any criminal backgrounds or any issues like that. So you can do certain things. I mean, it's never going to be perfect, but it's a heck of a lot better than doing nothing. And if you get a gut feeling that something isn't right, stay away from the company. Yeah, speaking of scams too, somebody mentioned about scams. There was another report. Let me show you this real quick. Where is it? Here we go. £178 million lost impersonation scams last year. So, impersonation scams, these things are just rife. I get at least 4 or 5 phone calls a week from people claiming to be certain companies. I've gotten ones from, let's say they're from the HMRC or from the IRS, from the tax, from Better Business Bureaus, and these companies out there are just trying to basically scam you out of your money. So just be very, very careful out there if you get a phone call. I generally think that cold phone calls are best just not even answering them and hanging up, because likely there's just so many scammers out there. I'll tell you something that happened to me just yesterday. I had a phone call from a solar company, right, in the US. They're really pushing solar panels hard, and solar is just such a bad deal for the consumer because, number one, they make it seem like you're not paying for anything because they give you a loan, and then you're getting a rebate back with your electricity. But problem is you get stuck with the cost of solar, and you got to pay that loan back one way or another. The problem is if you sell your house, you decide you don't want to live there anymore, guess what? You either have to pass that expense on to the next home buyer, or you have to pay off the solar loan. Neither one of those is really a good thing for you financially, because if you're somebody that's going to buy a house with solar panels on it, and the previous seller says, oh, well, the house isn't 300,000 now, it's 320 because you need to pay 20 grand for the solar, but you're going to save yourself 50 pounds or 100 pounds a month in your electricity. If you do that math, it's going to take you a long time to pay off that solar. So I think personally solar is a bad deal. And then also the batteries after 10 years or whatever it is they just become useless and they go into a recycling heap because solar is too expensive to recycle. The batteries are too expensive. They're not cost effective to recycle. So they're just going on to basically rubbish dumps at the moment. There's a big problem. So anyway, this company calls me up and I'm kind of yanking their chain a little bit. I'm pulling their leg because I know I'm not going to buy solar. And next thing I know, I get a knock on the door the next day at my house from the solar company. They just sent somebody over to my house to give me an appointment, which I didn't ask for. I told them no. So just watch out for these companies that are calling you on the phone. They can get you into some trouble. Just a quick story from your Uncle Lawrence. Oh, okay. Well, good to know about the interest rates. Coinbase is looking to relocate in the UK due to US regulatory issues. I wouldn't be surprised. Yeah, US is starting its own digital currency for the government, so they're probably going to put a lot of pressure onto companies like Coinbase. I'm not sure that that's going to make much of a difference. I mean, well, on the one hand, they are listed on the stock market, so that may be kind of a negative if they were to move out. But there's a lot of companies that are not in the US that sell, crypto as an exchange. So it is what it is. All right, we've been going long enough. What is it? We've been going an hour and 2 minutes. Anyway, come back next week. Folk to Focus here live. Bring your questions, bring your ears, bring your knowledge. But don't bring your tears. That was a rhyme. Say goodbye to Holly. She snoozes the evening away. We'll see you next Thursday. Have a great weekend, everybody. Much love to you. Thank you for joining. Please hit the thumbs up before you go. Subscribe to the channel, all that good stuff. I'll see you next week. I hope you enjoyed the content, and that's all I got for you today. Take care.